morning and welcome to another edition of the Ashworth Wealth Weekly Market Update. We are happy you're all here with us and have a little bit of information to share with you today. Today we're going to talk about the jobs report, and one of the things that happened last week was the Fed raised interest rates to where it's now 5 to 5.25%. And with that interest rate hike, there are a lot of people that feel like that's probably going to be the last interest rate hike that we'll see. One of the items that the Fed has been watching is the wage growth jobs report, and we've got a chart here showing that today. And we've had a significant slowdown. We've got layoff of workers that has increased, and not as many new job openings have been posted. So we can see that there's an overall weakening of the overall jobs market as far as the growth on that. But even with that, if you see here on the very tail end of that chart that we have, you can see that there was a stronger than anticipated wage growth, job growth report coming in just last week. And so we expect that to be kind of a short-term blip. We don't think that that's going to continue. Right now, all of the jobs that have been, people that have been laid off from their jobs or people that have quit jobs, there have been enough job openings that that has been absorbed. But we don't think that that's going to be the case long term. We feel like that wage growth is probably going to continue to decrease as it has been over the last few months. With that said, an interesting note, I heard today that Apple issued a new bond offering, and it was a huge bond offering. I don't remember the amount, but it was a fairly significant offering that they're going to do for 30 years, and they're anticipating about a 3.5% interest rate that they'll have to give on that bond offering. The interesting thing, however, is that Apple has a ton of cash on the sidelines already, and so they've got a lot of people kind of scratching their head figuring out why they would want to raise that much more money when they've got so much cash on the sidelines. In fact, they were mentioning today that the amount of cash that they have on the sidelines is more than the gross domestic product of some of the countries some of the smaller countries around. So anyway, they've got a ton of cash right now. But the bottom line is that they would not be raising that cash in a bond offering unless they thought that their stock was going to do well. And that's been the storyline that we've had throughout this interest rate cycle, is that corporations find a way. They find a way to make it work. They find a way to navigate through the interest rates, and they find a way to still make profits. So with that, we anticipate some continued volatility in the marketplace. We have not fully gone through this cycle yet. We do anticipate a small recession of some kind. But feel like that the markets will respond favorably as we start readjusting for the new economy and the new interest rates. So with that, we'll go ahead and close it for today. Thank you so much for tuning in. We appreciate your time. And if you have friends, family, or associates that you know that would like to be part of our podcast, please feel free to forward our link to them, and we will be happy to do that for them as well. Again, thank you, and we will see you next week. Thanks.